Good evening, everyone. We'll start this presentation in 5 minutes.
Yeah, hi Pooja, I'm here. Am I audible?
Yes, Aakash.
Yeah, let's just wait for Mihir.
Aakash, should we start? Can we start, Aakash?
Yeah, has Mihir joined?
Not yet.
No, you've not joined. One second. Pooja, Mihir has joined, I think. Just make him panelist. Hello, Pooja, can you hear me?
Yes. Yes. Yeah.
Yeah, okay. Okay.
Let us start then. Good evening, everyone. Sorry for this delay. Thank you for joining us today. Today we will discuss potential alpha generation opportunities, and we have with us Mr. Mihir Vora and Mr. Aakash Manghani to provide their valuable insights. Mr. Mihir Vora, Chief Investment Officer at Trust Mutual Fund, who brings with him an impressive 29 years of experience in fund management across various verticals within the financial service industry. Mihir has held senior roles at prestigious organizations such as Max Life Insurance, HSBC Mutual Fund, ICICI Prudential Mutual Fund, SBI Mutual Fund, etc. Mr. Aakash Manghani, he's a fund manager equity who comes with over 14 years of experience in equity research and portfolio management. Aakash has worked as a fund manager at ICICI Prudential Life Insurance and Boyaxa Mutual Fund. Both Mihir and Aakash brings a wealth of knowledge to the table, and we are looking forward to an insightful discussion on how to identify and capitalize on alpha generation opportunities in the current market scenario. We request you to drop your questions in Q&A section and we'll answer those questions at the end of this session. Let's begin. Over to you, Mihir.
Thank you, Pooja. Am I audible?
Yes, Mihir.
Okay, great. Good afternoon, everybody. Happy to be here again this month, attending this, review of what I would say are markets and trust mutual fund strategy. So let me start by sharing my screen and take a wrap up of what has happened in the markets over the last few weeks, of course, but more importantly, also to take a stock of how the year has gone by since we are in January. first day of the year. Just give me a minute. So I've shared my screen. I hope that's visible.
Yes.
Okay, so just let's take a wrap of how the year has gone by in the stock markets. First of all, that's more important. So if you look at the trend in the last 12 months, essentially what has happened is while the Nifty has given some returns, it's actually been outshone by a lot of stock picking and a lot of stocks in the wider market. So
if you can zoom it a bit, maybe 130%.
Yeah.
Yeah, much better.
Yeah. So if you look at the Nifty returns are actually about 10% on total basis and 8.8% on a non-total basis. So the Nifty headline returns are about 8.8%. But if you go further down the curve, it's actually the sectors and small caps and mid caps that are one way. So the mid cap 100 index is up 23%. Mid cap 150 index is up again 24%. Mid and small is about 25%. Nifty small cap is done 26%. And if you look at some of the momentum indices, some of the other indices, they have done quite well. So the best performing sector, of course, was defense, followed by pharma, and followed by realty. So the quirk of this year actually has been that you have high beta sectors in the top performers, which is defense and real estate. But you also have pharma, which is supposed to be a low beta sector, which has also done very well. So it's a very unique market, I would say, a very interesting market, and excellent market for stock picking. That's what I would say the year has been last year. The underperformers, I would say, just a minute. The underperforming sectors were actually private banks, FMCG, energy, commodity. So in general, commodities and financials did not do very well. And that's exactly the reason why the Nifty did not do as well. Because if you see the composition of the Nifty 50, it's about 35% of financials, which are here, not done too well. And it's also about 15% in IT, which has done okay-ish. But it also has a lot of commodities and energy stocks, like including the petroleum stocks, the oil marketing companies, the upstream oil companies. So all those commodities, IT, and financials weightage has led to the underperformance of the large cap top 50 stocks. And the wider market, as you can see, as we go up, it has been dominated by the small caps and the mid caps. And we talked about the sectors also. So I think it's been a market for stock picking. Broader market earnings have been better than the Nifty 50 earnings. And we do believe that given the state of India's current development phase, growth phase, or whatever you call it, that trend should continue. The broader market continues to look more interesting. India's growth is being reflected more in the wider market compared to the top 50 stocks. And while, of course, it's important that the top 50 stocks do well, even if the market does lackluster in a given year, I think there is enough scope always for stock picking in the Indian market. So that's one key message that one can see from the performance of the markets last year, that there are always years where the markets may not do that well. So Nifty at 8% is okay returns, below the historical average returns. But if you look at the wider market and stock picking potential, that has done very well. And to a great extent, we've always believed that. So for those of you who've been following us since our first NFO of the equity flexi cap fund, we've always said that India is a stock pickers market. While of course it is important to take a view on the overall market, macroeconomics, etc. Ultimately, it all boils down to stock selection. So with that philosophy, we've been managing the funds, and thankfully that has worked very well last year. The stock picking approach. And both our funds, the flexi cap fund and the small cap fund, have managed to deliver significant absolute returns as well as significant alpha versus the respective benchmarks based on this approach. So we believe that 2025 should be a similar year where we are not building in huge expectations at the headline numbers in terms of index returns. I think if you see the bigger picture, 2023 was a good year where the Nifty delivered 17%, which was a very good number. Then much above average long-term averages. Then 24 was a average below average year, 8.8%. So we're kind of evening out. So even if we get an average year of 8-10% on the Nifty or 10-12% on the Nifty this year, there can be enough scope for stock picking in the wider markets where you can still make some additional returns. So that's broadly our stance going forward. So with that wrap up of last year, let's just take a look at a bit of the macroeconomic situation globally as well as in the world. So in the immediate next 1-2 months, what I'm looking at very closely is what the US dollar does versus the rest of the world. What's the situation of US interest rates, the differential versus India. What Mr. Trump does in terms of his policies, because the inauguration is just in a couple of weeks now, and it'll be very interesting to see what Trump actually does compared to what he's been making noises on in terms of tariffs, protectionism, make in America, MAGA, etc. And of course, at the end of the month, we have the union budget for India. We're not expecting any fireworks, frankly. And the way the finance minister does things, I think no bad news will be good news. That's my approach for the budget. So no major predictions from the budget. I think we'll continue on the path of fiscal prudence. But let's come back to the macro situation of the dollar. If you step back and see broadly what has happened is that the US has continued to spend post-COVID also in terms of fiscal deficit. And that's the reason why you see US growth has done very well. And that's the reason why you also see the US markets have been the best performing markets for the last many, many years. And that's entirely because of this massive fiscal deficit that the US has been running consistently for the last 5 years. After COVID, there was no reason to run a fiscal deficit, but Biden and his approach has been very populist in nature, and that's the reason why they've been continuously spending money fiscally also. What has happened is while that has sustained US growth, and as I said, US growth has led to US spending has led to better growth. It has also led to inflation. So inflation expectations in the US continue to be elevated, and there is good chance that the inflation may actually be higher than forecast, and that's the reason why you saw the longer term markets have actually behaved in a different. The bond markets have actually behaved in a quite a different way. So we believe that the policies by the new government in the US may lead to fiscal slippages again, more tariffs on import, and lead to higher inflation. And that's exactly the way the US bond markets are behaving. So if you see, there's a conundrum. This is the first time, probably second time in history, maybe in the last 60, 70 years, that the US actually has started cutting rates. So if you see the blue line here, that's the US Fed fund rates. They have actually cut by almost 1% in the last few months itself, very sharp cuts. But the 10-year bond yield actually has moved up, which means that the market is telling the world, the bond market is telling the world that yes, while you are cutting rates, but you are not still fiscally prudent, it will lead to higher inflation, which means that there'll be more supply of paper at higher interest rates in the future. So the longer term situation is still a cause of concern. And that's why long bond yields actually went up when the Fed has cut rates. And that's a very unique situation that we have seen going forward. And because of the bond yields, long bond yields moving up in the US, you have seen that dollar, this is a DXY dollar index, dollar has strengthened quite a lot against most of the currencies, almost by 8 to 10% against the basket of global currencies. And that's the reason why you are seeing that there are outflows from all over the world in equities and inflows into the US. So if you see the one of the reasons why India is also seeing a lot of outflows from FIIs, last 3 months have seen a huge amount of equity selling by FIIs. And that's the reason for this is that it's all going into the US. So if you look at the bottom right chart, a lot of money is flowing into the US. equities because of high growth. So, the dollar strength is one of the key variables, as I mentioned in the beginning, to watch for. And US interest rates is the other thing to watch for, because ultimately something has to break. You cannot have a situation where US growth continues to be high, inflation continues to be high, interest rates continue to be high, and equities continue to be high. Something has to break. So that's the reason why I think the next few months will be very interesting and volatile to watch. What has also happened to note is, for the first time, you are seeing Chinese bond yields also moving in a different direction. So China is slowing down, we all know that, but the extent of the slowdown seems to be deeper than expected. So while the US bond yields have gone up, China bond yields, the bottom black line, are actually at record lows. The Chinese 10-year bond yield is below 2%, but the US 10-year bond yield at 4.6%. This is something that, 30 years ago, 20 years ago, we would have not imagined, because typically so-called emerging market bond yields are supposed to be lower than developed market bond yields, but that's no longer the case for a long period of time. So you are seeing a different world order, different world economics. That's what's making the situation quite fluid, I would say, and quite interesting. Uh, there is some weakness because of that in the domestic situation also. Sorry, yeah. So the continuous FIS selling has led to depletion of our FX reserves. So you can see that the FX reserves from almost $700 billion has come down to about $640 billion because of RBI selling dollars to maintain the rupee. And like a lot of other currencies, the rupee is also weakening against the US dollar. We are at about 85.9, 80, very close to 86 as we speak. So I don't think it's a cause for worry. Our import cover months is quite comfortable. But the devaluation of the rupee obviously is in line with the global situation. On the domestic side, we are also seeing some indication of urban demand not being as great as expected, but we are still hoping that that should pick up going forward, given the inherent consumption strength. So I think if you look at some of the numbers, they are still good, but a little weaker than what they were a couple of months ago. So I would say cyclically, we are looking forward to a better season going forward in March, because of the as the winter crop comes in, we are very close to Lodi and Holi and all those periods. We should see the activity coming back in the system. So this consumption strength is something that we should continue to watch going forward. The RBI is projecting a gradual inflation reduction towards a target rate of 4%. But I think, given the slight slowdown that we are seeing, the RBI stance might now give precedence to growth over inflation. So I think a still robust US economy, but with high inflation, and an RBI likely to turn dovish, and Indian growth, while is still good, seems to be faltering a little bit. So that's the situation with which we are working on. So if you look at the Nifty 500 earnings estimates, they've been cut by a little, about 3-4% in the last couple of weeks, 3-4 weeks, I would say, and that's a lot of because of commodities and some of the slowdown that we talked about. But overall, I think growth is still robust. So that's the background of the domestic economy and the global economy that we talked about. How are we positioned in our funds? The FlexiCap fund continues to be positive on the industrials, the cyclicals, as I said, because we do believe that government spending and government encouragement on infra and manufacturing and capex for the private sector will continue to play a pivotal role in growth for India. So as you can see, we are significantly overweight on the industrials sector. In healthcare, we are bullish on not only the pharmaceutical exporters, but on CDMO companies, on diagnostics companies, on hospitals. So we have a whole bunch of companies across the spectrum in healthcare on a bottom-up basis where we are positive on. As you can see, energy and commodities, we almost have zero exposure to. That's because of our view on the Chinese growth as well as global growth, because China is the largest consumer of commodities and energy. And since that's slowing down, obviously we don't see too much of a structural upside in energy and commodity stocks. So that's where we have almost a zero exposure to. On discretionary, we are overweight. As I said, urban demand, while it has slowed down a little bit, it continues to be one of the key drivers, and most of our exposure is in discretionary, in stocks which are more catering to the premium consumption theme, which we have a long-term bullish view on. We are also positive on some of the mid-cap IT stocks, and that's how we are in terms of sector positioning. So we are still sectorally, I would say we are still betting on growth. We do believe that the segments and stocks that we are in our bottom up selection will demonstrate good earnings growth. And I think that over the longer term, these are the segments which will continue to grow at a compounded rate, which is what our primary objective is. If you look at the composition of large, mid, and small caps in the portfolio, we have about 26% small cap, 26% mid cap, and 40% large cap in the flexi cap fund. This 26% small cap used to be close to 30% last month, but because of the reclassification starting December, a couple of stocks have moved from small cap to mid cap because they've done very well. So the mid cap exposure, which used to be closer to 23%, has gone up to 26%, and the small cap exposure, which used to be closer to 30%, has gone down to 26.5%. So it's not any selling or buying of stocks by us, but it's more because of the AMFI reclassification. We've always said that we'll maintain about 40 to 60 stocks. So currently we have 62 stocks in the portfolio. If you look at the stock selection, we continue to have some very unique bets in the portfolio. So if you look at the right hand side, which is the top 10 small caps, we have a fair bit of interesting stocks in the portfolio, which we believe are very high growth stocks for a long period of time, meeting some of our criteria of gorilla investing, as we call it. Similarly, on the mid cap top 10 securities, you can clearly see that we have a very strong growth bias, which is exactly in line with our investment philosophy of growth at reasonable valuations and terminal value investing. So if you look at the absolute returns of the portfolio, so since So since 26th April, which is the inception date, which is less than a year, the FlexiCap fund has has demonstrated good performance. Our returns are about 21.5% absolute compared to the Nifty 500, which is about 8%. So we have a very significant alpha of 13.4% versus the benchmark. Versus the category of 39 funds that we have, again, we have similar alpha of almost 9.47 versus the category median returns. On the small cap fund also, which is like only about a month and a half, we have delivered 8.6% returns since 4th November against the benchmark, which is flat, so almost an alpha of 8%. I will also talk about the the small cap fund. The small cap fund is similar in terms of what I would say stock picking approach, but of course we don't have any large cap. We don't have any large cap in the portfolio. We got about 18% mid caps and 73% small cap. So it's a predominantly small cap portfolio. If you look at the sector overweight, underweight, the direction is pretty similar. Healthcare overweight, IT overweight, industrials overweight, and negative on commodities and energy. So the broad call remains the same. These are the top small caps and mid caps in the portfolio. Again, very strong growth bias. So in general, I would say that our portfolios are growth biased, and to give you some data, our EPS growth for the next couple of years for the FlexiCap fund portfolio is about 34%. with a PEG of 1.2, which means that we got about a PE of about 30 for the portfolio on a forward-looking basis. But then the earnings growth is more than that, 34%. So on a PEG ratio, it is 1.2. Similarly, our small cap fund EPS growth is about 40%, very high EPS growth. And the PEG is about 1.1, 1.2 there also. So that compares very favorably with the benchmark. The benchmark PEG is also about 1.2, 1.3. So while our portfolio PE would appear higher, our growth is also equally high, which means our PEG ratio in the short term is quite okay. And that's, I think, a function of our stock picking approach. So I think that's what I wanted to cover quickly. And Pooja, over to you.
Thanks, Mihir. We already have one question, so now we'll start taking questions. One is, what is your take on small cap stocks in the current market environment? What are your thoughts on renewable companies as well as the green energy sector?
Sure. Aakash, you want to talk about the small cap fund and small cap stocks selection?
I missed the question. Sorry. What is your take? Okay, I read it. What is your take on small cap stocks in the current market environment?
Yes, right. And what are your thoughts on renewable companies as well as on the green energy sector?
New age companies and the
Yeah.
green energy.
New age, yeah, it's a new age. Yeah.
Yeah. Okay. So I'll take the first question to start with. See, look, for the last couple of months, we've been quite bullish on the small cap and mid cap segment, actually, more for the small cap segment. The basic construct of our economy, the way it is progressing, a lot of the sectors which are high growth, which are growing in excess of nominal GDP, which is about 10-11%, are available primarily in the small cap universe. A lot of the structural mega themes such as capital market, manufacturing, EMS, pharma, hospitals, healthcare. So all of these themes are not available in the large cap universe. We maintain this view that the large cap universe is quite lopsided and only about 4-5 sectors contribute about 75 to 80% of the large cap sector. So if one needs to sort of create handsome compounding over the next 4, 5, 6 years, you need to be present in the small cap universe and you need to be levered towards these high growth sectors. Now, coming to the very here and now basis, what has happened in the last 6 months specifically is that we've seen a slowdown in the economy. Q2 GDP growth was suboptimal at about 5.4, 5.5. We've revived about Q3. However, economy growth is much lower than what was initially anticipated at the start of the financial year. So that's one point. Now that has percolated down into slightly poor earnings growth coming at the broader market level. So Q2 earnings season was a bit of a dampener where the earnings growth was only about single digit for the BSE 500. For the small cap universe, again, was about single digit. Q3 also, the anticipation is that the earnings growth will be in the vicinity of 5, 6, 7%, not more. This is on the back of FY 21 to 24, last 3 financial years, where you had stupendous earnings growth. You had earnings growth in excess of 23-24% CAGR at the small cap and mid cap indices levels. So to get single digit earnings growth is a dampener. So markets are sort of in a wait and watch mode to see whether earnings will come through or not. Valuations have skyrocketed in the last 2-3 years. So it's actually a tough situation to be in. So you actually have to look beyond the immediate quarter or beyond the immediate 6 months to figure out businesses, promoters, companies which can continue to compound at a handsome clip. So maybe you have a volatile phase of the next 3 to 5 months where making money will not be as easy as it was in the last 12 to 24 months. Stock picking will come to the fore. Fund managers who are backing sound business models, who are backing fantastic promoters who can sort of wade through this challenging period will eventually be rewarded. So that's my view on the current environment. With regards to the next question, thoughts on new age companies and green energy. So look, energy transition, I'll start with that. That's a pretty big mega theme that the world is witnessing. And this has been in play for the last 3 to 4 years, specifically after COVID. where between now and 2050, probably over the next 25 years, the world is moving from fossil fuel energy consumption to renewable energy. So in the last decade, renewable energy was a very small proportion of global energy production. But in the next 15, 20, 25 years, renewable energy will be more than 70-80% of incremental energy production. Now, this has implications on India as well. So in India, government has said that a lot of the production over the next 10 years will be either via solar or wind. And there is a very large ecosystem of companies today available in the listed market, which are catering to both solar or rather to the entire renewable energy space. So we are bullish, but you need to see individual companies at an aggregate level. The sector looks bullish. Each company has a different business model, different ROE, ROC profile. So we have some sort of a presence over there, and we are playing it through some capital good companies, which are actually pickaxe shovels to the entire theme, which are deeply moated. So that's my view on the energy sector. On new age companies, so these are companies which are, probably catering to the internet economy, and we've seen a flurry of IPOs in the last 2-3 years, and we will continue to see in the next 12 to 24 months a lot of IPOs coming through with these new age companies. We are quite positive on some of these business models. A lot of these companies have got their unit economics right. They've realized what it takes to win in the stock market. Losses, that they've ramped up in the last 5-7 years because of poor unit economics and aggressive spending. I think that's become they've returned to sanity. So companies on the food delivery or quick commerce, we've seen in the last 12-24 months, so they've got back to profitability. So this is a sector which offers growth of the order of 20-25% for the next decade or more. In some categories like quick commerce, the growth rates are in the excess of 35-40% CAGR. They've grown at 70-80% CAGR in the last 3 years of a very small base, but the outlook is that they will sort of grow at a very brisk pace. So we are quite positive, and we'll take each business model by business model and see whether it fits in our parlance or not. So yeah, so that's my.
Thanks, Aakash. You have one more question. Can you just repeat earning growth for small cap fund?
The small cap fund earning growth for the next average for the next couple of years is about 37 to 40%.
Okay. And what is the basis of selling stocks from small cap fund?
So not only for small cap fund, but in general, there are a couple of three things that we actually take care of in our portfolio, because our philosophy is that of terminal value investing, which means that we are really taking a longer term view on growth. So ideally, we would like to keep holding the stock for a long period of time, as long as the earnings are coming through, and as long as we think that the original thesis, based on which we bought the stock, is still intact, then we would continue to hold the stock for a long period of time. So every quarter, once in a while, every quarter we get results, plus we are meeting the companies multiple times a year. So we keep testing that original thesis. So as long as the thesis is there, we hold on to the stock. If we think that 1 quarter, 2 quarters, 3 quarters, the numbers and the thesis is not turning out as we originally thought it was, then we would start taking a relook at the portfolio, and if we at the stock. And if we think that maybe our thesis was wrong, or maybe circumstances have changed, and we need to change the thesis or sell the stock, then we would sell the stock if the original thesis is not working out. So that's one. Second is if valuations go berserk completely because of irrational reasons. So what happens is that while we are looking at earnings compounding of 25, 30, 35% odd, that's over a period of time. And ultimately, we do expect that stock prices will move in line with earnings. And if earnings are compounding at 25%, the stock should also give a compounding of 25%. But sometimes it happens. The earnings suffers are coming through, but the stock goes up by 100% or 200% in a short period of time, which happens from time to time. So if we think that probably it has overshot a little bit, or its earnings or the valuations are no longer reflecting even the bullish estimates that we have, then we would sell based on irrational valuations. And the third situation is where we like the stock that we hold in the portfolio, is done well, but then we have a new idea which probably is better than what we have in our existing situation. So we would then sell the existing idea and switch to a new idea which is even better than what we are holding in the portfolio. So this continuous and active monitoring of the portfolio is what helps us to choose the sell ideas also. And to that extent, we also pay a lot of attention to earnings upgrades and downgrades. So whether the market is upgrading its future estimates consistently is a very important factor for us, and similarly for downgrades. Because we have seen that the trajectory of earnings upgrade or downgrades and the valuation move in the same direction. So if a stock is continuously seeing upgrades in the optimism or the estimates that the market is building in for the next 1-2 years of profits, then we see the valuations also increase in the same direction. So that's something that is very crucial to us. We pay a very close attention to earnings upgrades and downgrades, and that's one of the factors that we also use to select stocks that we want to sell.
Mihir, one more question. What are your views, especially for banking and NBFC stocks?
Sure. So I think banking and NBFC put together are at a very interesting juncture. We have seen underperformance of these segments for the last almost 2 years, and that's because of the fact that first in the first 4.5 years, RBI has been keeping liquidity very tight, and that's leading to banks, not really compromising on margins, but more impact on credit growth has been seen. So because of the tight liquidity, we are seeing that banks are facing a tough time gathering deposits, which is the liability. And if you are not able to generate liabilities and deposits, obviously your ability to grow credit is also reduced. So we have seen credit growth come down from 15, 16, 17% to almost 10, 12%. So that's also the reason why we have seen the banking sector and NBFC stocks underperform in the last almost 2 years now. Having said that, because of this underperformance, valuations have come to very attractive levels. And I believe that if India is to actually grow at 6.5, 7%, then the credit growth has to be at least 12 to 15%. And that if that happens, then we should see the banking sector come back very, very smartly, because valuations are really at 2-3 year lows, and balance sheets are very clean. There are no NPA issues, and RBI is looking at starting to ease the liquidity situation. So all the factors and the base has been set, both in terms of valuations as well in terms of balance sheet quality and earnings for the banking and NBFC sector to start outperforming with a little bit of a trigger from the economic growth.
So the next question is, what is EPS growth rate expected for both of our schemes, and based on what duration? And is it projected EPS growth rate or existing growth rate over last quarter year? Please clarify.
What
I can
I
take
told
that.
was, yeah, you can take that.
Yeah, so the numbers that Mihir sir mentioned was an average of FY 25 and 26. And this is not for all the stocks. The way we've done it is a weighted average portfolio EPS growth. So the EPS growth is weighted for individual allocations to stocks. So it doesn't mean that all the stocks will double EPS in the next 2 years. There are some stocks which are growing at 20-25%. There are some which are growing at 40-50%. So it's a weighted average number.
So the next question, Aakash, does 40% EPS growth rate you're mentioning for 2 years translates to almost all companies doubling EPS in next 2 years? So I think this is
I
what
just,
you're.
I just answered that one. Yeah.
What's your view on infra?
So infra is a wide canvas. Broadly speaking, what we have seen in the last few years is sectors which are linked to government spending have done better. So your roads construction, ports, some of the existing airports being upgraded, etc., by the AI that has done well. The other sectors which have done well is renewables, solar power, wind power ordering has started. Solar power, of course, is doing very well. Hydro is also being ramped up a lot. So I think in general, the power sector, including transmission and distribution and generation, is doing well. Roads is doing well. But now we expect also the small ticket capex also to pick up, and we are already seeing that in the order books of capital good companies. So I think capital goods, construction, renewables, defense, railways, real estate, everything put together, all the physical asset creation themes we are positive on.
So what is your recommendation on lump sum additions to in flexi and small cap in this volatile market?
So we always say that it all depends on your asset allocation. So if you are starting for the first time, then maybe you want to put some amount in lump sum and then stagger the balance in terms of SIP flows. But if you already have a significant book with us, then you can probably start with a SIP or a systematic transfer plan.
Where there is a question like outlook on GDP and also on the company's profitability growth and sales growth.
Sure. So for the Nifty 500, we are looking at a EPS growth of about 15% to 17% for the next couple of years. For the small cap index, it looks a little higher at about 17 to 20%. That's the profitability growth that we are looking at based on the current consensus earnings expectations. GDP growth, we are expecting about 6.5% for the next couple of years. But we'll see how it goes. More importantly, as I said, GDP growth is one aspect, but we really need to then boil down to specific stocks. And that's what our focus has always been.
Thanks, Mihir. And about our performance, that is the last question actually. So will it continue? So though we can't comment on the performance, but that would be our effort to deliver the best opportunities for alpha generation. You want to answer this? How has the Trust MF managed to deliver over 10% alpha despite the volatile market condition?
So as I said, we've always we have always focused on stock selection, and of course the portfolio construction ultimately is also a function of risk management. So while we do active stock selection, we are taking active bets against the benchmark. As you saw, we are quite actively zero in commodities, zero in energy. So those are very high conviction bets that we took. And of course, we have 30%, 26 to 30% exposure to small caps, which is again a bottom-up high conviction stock picking approach. So we believe that this stock picking approach, not taking too much of asset calls, that has worked well for us. And inherently, the Indian market and the Indian economy is a growth market and a growth economy. So I think, as I said very clearly, we are growth investors. And that's what's working for us in these kind of conditions. As long as the markets don't collapse or don't fall by 15-20% suddenly, that should continue to work. But if the market goes through a very rapid crash, then of course we can't do too much beyond a point. So while we still may generate alpha, but we can't guarantee absolute return.
So I'll probably add one or 2 points to that. So in the last year, a couple of sectors have done very well and a couple of sectors have really underperformed. Like banking has underperformed the Nifty. Financial services at a broad level has underperformed, for example. So we've allocated smartly to sectors which were exhibiting decent amount of growth and we took disproportionate exposure. So for example, we are underweight banking, but we are heavily overweight capital markets. We've been heavily overweight healthcare in both the funds. Right from we started the fund, we've had a sort of significant overweight towards healthcare. At the starting of the fund, we were overweight capital goods, but within that, we had taken significant exposure to defense. And as Mihir showed you, defense has had been the best performing sector for the last calendar year. But again, there's a story of two halves. Defense did very well up until the elections, but or up until the budget that came. But after that, the defense sector has been on a downward trajectory because the capex spend in defense had not been increased and people were sort of not sure how the defense growth will be from the short-term perspective. So we made a lot of money in defense, but we were smart enough to get out at the peak. And since then, a lot of the stocks have fallen anything between 25% to 50%. So smart sector allocation, smart stock picking, and exits in a timely fashion, to summarize, has been the result, has been the reason for this alpha so far.
What we call, basically, we are active managers, not only in terms of actively monitoring the portfolio, but taking action as and when required, both on the buy side and the sell side, and also active bets against the benchmark.
So, in view of heavy redemptions